Do you provide any ground up construction or new construction loans? All right, guys, let's talk all about new construction. So the difference between rehab and construction really comes down to changing the footprint. So basically what we consider the footprint of the home is if you were looking down on the house, and let's say this is the house and this is the garage, type of idea here. You're looking down, there's a bedroom here, there's a bathroom here, there's bedroom, whatever the case is, you're looking down. So if you come in and you move this wall over, move the foundation over and that type of stuff, that's where we start talking about construction. If you keep the footprint in place, all of this is what it is, but you come in and you move this bedroom, you make bigger, and this bathroom you put here, or downstairs in the basement, you finish the basement that wasn't already finished. We call that rehab, okay? Fixing up what's currently there. Construction is where we're saying, hey, we're going from ground up. Okay, construction is a different animal. So if you're going to do construction, you've got to know what you're doing. And so you've got to work with a licensed general contractor and some of those things. But first off, we do have options. Okay, so options that are designed for ground up construction or new construction. First off, we can go up to 85% of loan to cost. What that means is if you are buying if you're buying the land for $100,000 and you're going to spend, I don't know, $300,000 building, let's just say, so it's total cost of $400,000. Okay, that means 85% of loan to cost means you would have to cover 15%, and we could get a loan up to 85% of that. So, okay, so if the land is $100,000 and the construction is $300,000. 400,000 total times 0.85 means funding would be for 340,000 would be the loan amount. And then the down payment you'd have to come up with would be $60,000. Okay, that would be you, and this would be the loan. Okay, the next thing we're going to talk about is loan to value. Loan to value. This is the amount of the loan divided by the value of the property. This is going to be determined by an appraisal based upon everything that's happening here, your blueprints, what you're doing, what you're spending, and those types of things. So if the value of the property, once it's all done, came in at $450,000, okay, and your loan amount is for $340,000, we're going to divide those two to get what we consider loan to value. Okay, so loan to value is if the loan's for 340 and the value is 450, that's going to be 75% loan to value. Now, what you're going to need on these new constructions loans is 70% or less. Okay, so that's going to have to come in just a little bit more, or the costs are going to have to come down just a little bit, or you'd have to bring more money in. So at 450 times 0.70, the maximum loan amount would be $315,000. Okay, unlike the 340. So if you still were going to be 400,000 into this, what it would do is increase how much you'd have to bring in, which would be the difference between the 340, which would be an additional $25,000. So you'd be coming in with $85,000. The point here I want to make sure that you understand is it has to meet both these criterias. It has to be loan to value 70% or less, and not or, and 85% loan to cost. Okay, so at a minimum, you're going to be coming in with 15%. At a minimum, it may be more if the loan to value is a little bit off, but if the loan to value is there, so for example, if the loan to value on this would have been 5, let's just look here. If the loan's 340 divided by 0.70, 485, the loan to value would have came in at 485 based upon the appraisal. And this is all done by an independent third party appraiser. 485, then the 340 would have been fine, and we would have came in with $40,000. Okay. So that's the big criteria here is loan to value at 70% or less, loan to cost at 85%. Okay, so that's kind of the first thing to realize with this. Okay, typical loan amount on these can go anywhere from 100,000 up to 3 million. Okay. Loan terms are typically 13, 19, or 24 months. Really depends on the build time. So this is the term. Okay, this is the loan amount, max and min. Max and min. Okay. We do have some non-recourse available. However, non-recourse means you're not personally liable, that the property is the only recourse. If you do that, you may have a lower loan to value. You may have more costs, more money you have to bring as a down payment. So just be aware of that, but that is an option. The reason this is going to be really helpful if it's for like a 401k IRA investment. Also with this, we do have some interest only, because you've got to, with this, you're going to be making monthly payments. Okay. The other cool thing, unlike a rehab loan, is you can also, in some cases, is only pay for what you've drawn out on the interest. So for example, if you've drawn out 100,000 and the interest rate's 10%, $1,200 a month. But then next month it goes up to 200,000, then you're going to be at $2,400 a month, right? And then if you end up getting all the way up to your million, if that was your max loan amount, then you would be paying. So the payments incrementally go up as the draws go up, but you do have to plan on monthly payments for the entire term of the loan. That's what makes this different with the new construction. Also, credit score. Your credit's going to need to be 650 or greater. Your credit is going to have to be 660 or greater. And you can't have any bankruptcies, foreclosures, short sales, deed in lieu in the last 3 years. Let's write those out to make sure everybody's on the same page. No bankruptcy, foreclosure, short sale, deed in lieu, and you can't have any of this in the last 3 years. Okay, deed in lieu is basically you give the house back to the bank. You just sign it over to them and they take it. A short sale is where the bank takes a loss. You own the property, you work with the bank, but they end up taking a loss in order for you to sell the property, but the bank actually lose money. Foreclosure is the bank had to take the property back from you through a foreclosure proceedings, and bankruptcy is where you had to file illiquidity and do a bankruptcy. There's a Chapter 13 bankruptcy. There's a Chapter 7 bankruptcy. A Chapter 7 is a full dismissal. A Chapter 13, you're making payments, and if it's a payment plan, it's going to want to be 3 years from the time that Chapter 13 has been concluded. So something to keep in mind there as well. So those are the things. So in short, yes, we do have options for new construction, but it is more credit qualified. You've got to be that 660 credit score. You can't have the bankruptcy, the foreclosures, the short sales. Those are going to be some big things. Loan amounts anywhere from $100,000 to $3 million. You're going to at least have to be coming with 15% plus the closing costs, and you're going to be having to make those monthly payments. But you'll make that monthly payment on what has been drawn out of the loan so far, unlike you'd have with a rehab loan. Loan terms on these are 13 to 24 months, depending on the scope of the construction and everything else, and also what other needs you may have. Loan to cost is 85%, which means you'll be coming in with 15%, and loan to value is up to 70%. And so that's the max loan amount for the value of the property that will be established by an independent appraisal.